Okay, I think I've been given the go ahead to start. So today's topic is a very interesting topic. It is milestones to wealth versus direct stock investment, and we always keep getting these queries on how does milestones to wealth really compare to equity stocks, and is it better for me to do this or that? See, the whole idea of Milestones to Wealth is of a behavior model. It has nothing to do with uh, stock investments, or we choose mutual funds as a vehicle to save money. But the entire model is majorly driven in the form of behavior. Now, I sort of set up examples here. It's regarding behavior. This is all real. It is nothing to do with something that is a model, but these are all real time, right? And this is data that I have already presented before. So I thought that yes, I can take the same thing, take very important things of how what we have built Milestones to Wealth on, and what is the behavior that we have seen over the years, and what is something that we go out and follow. Right. See, in terms of the market cycle, you would have seen this in my other webinars also, but this is extremely powerful, right? Whatever I've put here in this webinar is extremely powerful, right? What I have found to be extremely powerful is what I have put here, right? Usually at the market top, you will see a lot of optimism. You will see a lot of optimism. You will see a lot of news coming in. When you read the newspaper, you will see that the headline number says India is growing very strong. This Nifty 50 is doing very good. Nifty small cap has done this much return. Basically, there will be a lot of positive news. There will be a lot of optimism that comes into the market, and you will find it even within your peer group. You will find it within your circles. You will find it wherever you go. That the conversation sort of starts becoming that yes, I'm also investing. Do you know about this stock? I'm investing in this stock. I'm investing in this fund. Do you know about this? And there people start getting validation. Basically what I'm trying to tell is there is a lot of inclusivity when it comes to a market top, right? A lot of new investors start coming in, and you will see that sort of optimism in the air about how everybody has made money, and you should also do the same thing. If you do this, you will be able to make this much. You will be able to get so many crores in these many years or so. And this is what you have noticed. Same way, likewise, when there are troubles in the market, when the market goes through a big turmoil, the sentiment reverses. It becomes more and more pessimism. Right? You will see people saying, "No, why are you doing this? You shouldn't be doing this." I got a tip from someone that something like this is going to happen. Nifty is going to go from one level to another level. You will hear a lot of during optimism, yes, from here to here. During pessimism, from here to here. Right? So this sort of behavior has gone in place for decades altogether. Right? And what is the outcome? Right? You go in at the wrong time and you come out. Uh, at the right time, and that's what I would say. Right, when fear comes in, this is a template, right? When practicality does come in, it takes a long time. It takes a long time for greed to play, and it takes a long time for fear to play out, right? It's not yes, today it's up 10%, tomorrow pessimism will start coming in, nothing like that. When when optimism comes in, optimism can stay for extremely long periods of time, and when pessimism comes in, pessimism stays for an extremely long period of time. One example of optimism is technology stocks in the US. You are seeing a wave of optimism in technology stocks in the US. This has been going on for the last 5 6 years, for which I have the data. 5 6 years, right? It's been going on for a long time, right? In 2010, the optimism was more towards before 2010, the 5 years back, it was more to do with commodities. Again, during 2000s, it was more to do with technology. Again, right? And now again, you are seeing optimism come in only in the uh, sub 150 stocks of the Nifty 50. You're seeing small caps again having this sort of optimism. Likewise, when it comes to pessimism, you're seeing the Japan index did not do anything. There were no returns made on the Japan index for 20 years. And it takes so long. It's very very vast. right? But you and I as investors can't sit in the sideline saying, no, I'll come in only when there's pessimism. No, 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 I know when to time the market. I'll come out only when there is peak optimism. That doesn't work, right? Nobody is built to know when a top comes. Nobody is built to know when a bottom comes, right? All you know is, yes, there is pessimism. How long is this pessimism going to go for? That you have to always keep observing. For that, always you have to sort of commit money. And the more you start building at a pessimism phase, that's when your expectation starts going up in terms of optimism, when the optimism phase comes in, right? Now, uh, yeah, right. That's where the optimism comes in, and you think that, yes, this is a great time for me to take advantage of this optimism. And when pessimism comes in, no, no, I'll wait for more pessimism to come in. So always remember that the market is one step ahead of you. Things get factored in very, very fast. And in this market, currently in the market that we are, there is no scope for factoring in new things. Everything is already factored in. The only thing that is not factored in are really bad things. And when the really bad things come, sentiment changes. It has nothing to do with fundamentals. It has to do everything with sentiment, right? So split the two things in apart. It's more, one basket is more fundamental and one basket is more sentimental. Right? When you do stock investments, you are majorly doing sentiment. You are not doing fundamental. Right? And that's why you see your anxiety go up and go down very, very fast, like how cycles go up and down. Your anxiety keeps on going up. Right? Now, this is a very powerful quilt. It says we updated it for 2023, but I'm going to go backwards. Huh? I don't know how many of you remember the entire chart and what we have actually spoken about it. But for those of you who don't know, for those of you who don't have that new memory, I'm just showing you the last 2 year returns, right? You're seeing gold up, you're seeing small cap up, you're also seeing a lot of other categories. You're seeing credit risk in 2022. You saw a little bit of large cap. Nobody did really well in the entire of 2022. International markets, that is the global markets, were down by 10%. This is majorly your world index, which is overweight on US. It didn't do really well. Your small cap and mid caps again didn't do well. GSEC, nothing. And in 2023, you saw small caps do extremely well. You saw mid caps do extremely well. International bounced back a lot in terms of sentiment. It did really well. Large caps, yes, it did very well for a large cap category. Gold, again, last year, 12%. In 2022, 12%. 2023, absolute return of 12%, which means they're growing very, very consistently. Right, you're seeing a low risk product doing extremely well, which actually means fundamentally speaking, macro is look the world over macro does not look really good. Right. So now I would raise a question. Assuming you started investing in 2020, where would you go out and start investing? Would you do gold? Would you do small cap? Would you do international? Would you do credit risk? So this is a poll. So you can put in your answers in the chat box. But I've shown you the last 2 year returns, and I'm telling you that no, you came in for probably 3.5 years back in 2020. I've shown you some facts. So what are you going to do, assuming you started in 2020? So you can put in your answers in the chat box. Somebody said credit risk. Only one of the participants has actually gone and said credit risk. I'm only seeing one credit risk. Everything else majorly is small cap and international, small cap and international. Then there's a little bit of gold and small cap, gold and international. Just one of credit risk. Okay, very interesting. Somebody commented, my inclination is usually towards large caps, a reasonable return, relatively low relatively low in volatility. Okay. Somebody said not sure about credit risk. Credit risk is basically high yield bonds. Their credit rating is usually low, and you're taking that sort of risk. They're not very bad, but they are somewhere on the depends on the mandate of the fund. Sometimes they might have more of A rated papers. Sometimes they might have more of double B, triple B papers. It's just somewhere where it's not triple A, yeah, and you are taking that risk of possibility of a default. So only one has said large cap. It's not even there in the option, but one said large cap. Okay, I'm impressed. Okay, so I'll go forward now. A lot of you said gold and small cap, and there was a mix of small cap and international, and there was a mix of gold and uh, international. So you have looked at the top three performing and said, yes, I want to, had I gotten a chance of doing something like this, yes, I would have done, just the top three performing, and I wouldn't have taken anything else. Now, I'm taking you further back. I'm taking you further back. Yes, you started in 2020, but look at 2018, gold was on top, 2019, gold was on top. Here, you have 2 years of really bad years in 2018 for small and mid caps. You're seeing somebody who put 100 rupees in the on the 1st of January in 2018. Okay. Now let's say you put uh, in on the 1st of January also, you put uh, money in small cap. Yes, you're up 30%. Again, from there, you're up 62%. Again, you're down. Right. Again, you're up. Right. But the whole point is there is volatility, right? There is volatility in this space. So because you already know what's going to happen, you've already seen that, yes, you're going with recency bias. You are not doing fundamental work to see if it makes sense for me to do this. You're just seeing the headline number and saying, yes, I want to do this, so I'm going to go out and do this. Right. No, fundamental backing, nothing in terms of, what am I really getting out of paying so much for particular businesses on the small cap space, particular funds on the small cap space. But I've seen that they have done extremely well. So I want to go out and do this. Same case for gold, same case for international. Right? There is no analysis done for risk and in terms of what you're actually getting out of that particular risk. But if you see from 2018, you're having gold at the top again. So you're having international wavering up and down. You're having two really bad years in terms of small cap, as you saw from 2020 uh, back then. So you actually started from a really high point when it came to investing in the small cap space. If had you invested in 2018, but since I asked you 2020, yes, you saw that definitely they've continuously kept on doing well because a lot of inclusivity has happened, because a lot of recency bias has come in, because investors think high risk is equal to high return, right? But I think there was one who said, I'm very much okay to make stable returns and I want low volatility in my portfolio. I don't want to see something like a 23% fall. I don't want to see something like a 9% fall. Right? I can't take that risk. I get really anxious and I want stable growth. Right. So here you are that, investors are actually going out and starting to take high risk for the sake of taking high risk. They are not taking risk to be rewarded, right? It's recency bias that's coming in, right? Just because they have done well, you have seen some articles, because there's optimism that comes in, you're okay to ride greed. Right? Very simple. Now, does your answer change? Knowing the facts, does your answer change? Are you going to stick to the same thing? Because I'm going to ask you previously also as to what, had you started from one point, what could you have done? Right. So does your answer really change? In the poll, you can put yes or no. Okay, somebody really said that, yes, I want to change my answer. I don't want to do what I said. No, okay, fair enough. Yes, okay. Yeah, since you have selected correct risk, no change. I completely accept with you. No change. Not sure, we'll probably go with a mix. Okay, very interesting. Yes, you want to change your answer. Okay. If prior to 2020, yes, see, this is exactly what I'm trying to tell you, that you don't know what is going to happen. You have to be cautious. You have to be conservative when it comes to valuations. But because you have seen something in the rear view, you say no. Because I know something, I don't want to do it. Yes, because you've seen something happen bad. I don't want to take that risk. Yes. So you have to take this sort of calibrated risk approach. You have to be what you learn from the previous markets, you have to take into the next market. You're absolutely right. But yes, if prior to 2020, yes, that's what your answer is. Okay, no, yes, no, and yes, many yeses that came in. Right? Many yeses that came in. So I'll go forward. Right now, you have seen this. Now, assuming you started in 2018, now I'm asking you 2018, where would you invest? Would you invest in gold, small caps, international, or credit risk? Same options. Same options. Now we are all we tell ourselves that we are long-term investors, right? How long is long? That again, I would like to ask you, but I've not put it here. Definitely in the Q&A session, we can discuss about it. But since we are all long-term investors, we only think of long-term. Milestones to only thinks of behavior from a very long-term perspective. What is it that now that you're going to start from 2018, you already know what has happened from 2018 all the way to 2023, right? Where are you going to go and start investing money? Nobody said gold and large caps. Small caps and gold, would have gone with gold and credit risk. Can we assume option A include large cap? Yes, you can assume large cap, no problem. I just put out the options. You can even tell me your answers, no problem. I'm expecting, yes, sir. You are expecting stable risk and you will go with gold and large caps. Somebody said small caps and gold. Somebody said, somebody actually said small cap and said gold. Basically, the two best performing asset classes, gold and small caps, is what you're going to go with. Right? You add in a one more layer, you say international. Okay. Right. Somebody said asset allocation, gold plus small cap is international. Yes, the top three. Understood. Then there was large cap. Right? Then there was gold and small cap. Right? Now, let's go further back to see if you again change your answer. Right? Remember your answers. Now we are here. Let's go back. 2014 all the way till 2017. See, because you start in 2018, you have to look back, right? Because we are investors, we will look back. We will look at the past returns and we will only judge with the past returns, right? That's how we are doing most of it. That's what the entire industry looks at doing. That's what you as investors also try to do when you want to choose a particular stock or choose a particular mutual fund. Exactly. Yes. So you start at 2018 means you look back. You look back 3-4 years to see what is the long-term return of that particular idea. You see, small caps did well in 14. Small caps did not do that great in 16, which means it's held. Small caps again didn't do that great in 16, and they did very well in 2017. But many of the options that were there were gold. We had two really bad years in gold, right? 2014, 2015, gold did not do really well. And 2016, gold did fairly well because we saw some up movement in the market fairly well. Somebody said large cap. Now, fact for large cap, 14 extremely well, 15 somewhat bad. It didn't do that well, but it held on. 16 stayed there. 17 did extremely well, which means actually speaking from a CAGR perspective, large caps have been very stable. Large caps have been growing very, very strong. They have been very, very strong in terms of performance that's been coming in, right? Then you see in international, it's wavering, right? International also has seen some bit of good performance, but something on the debt side. Somebody said credit risk. Credit risk in 2015 was the best. Credit risk in 2014 did really well, along with your GSEC. 2015 again GSEC. 2016 again GSEC, which means government yield and government bonds and your gilt funds were doing extremely well. Right? Uh, None of you said something on government debt also, but the main point is yes, they did extremely well. So from this chart, for gold investors, you had a really I don't know how did you decide to do gold in 2018, having seen 2014 and 2015 and back 2010 also, which I can show you later. How did you decide to go with gold, and where did you get that sort of conviction from? because the price has not gone up, right? It did not do really well. Right? From a behavior perspective, you are not going to go out and start doing it. Let's be honest. You are not going to do it seeing that it's done really bad return, right? Because that is let's it is a fact, right? Let's be real. Why is it not done well? Will people won't ask that question? Investors don't really ask that question. It has not done well. I don't want to stick to that. I only want to stick to the best performing thing, no matter what happens, no matter what the risk is. I want to be only that because I have seen a lot of people make money and I have seen there is so much optimism. I would rather do this than do the other thing, right? Now, does your answer change? Yes. Okay. Very honest. Very honest. I respect that. Very honest. Yes. Okay. Yes. Yes. A lot of yeses now. There were at least some no's in the previous time we sort of had this. Uh, okay. All of you that have actually participated here have been very, very honest. Your answer changes. Right. Your answer changes to what you said. Right? You said that you will do one particular thing, but then seeing further back, you said, no, 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 I don't think that I can really go out and do this. I think I should go back to the drawing board and think about what needs to be done. Now, here's 2010 all the way up until 2023. 2010 gold did well, 11 gold did well, 13 gold did bad. That is your best performer, right? In the last 5 years since 2018, gold has been the best performer. But from 2013 all the way up until 2017, gold was a laggard, right? And in my previous webinars also, I was talking about how when we invest for Milestones2Wealth, we only look at it from a behavior perspective, right? Why is it that gold actually underperformed and outperformed in the next cycle, which means that winners of the past need not be winners of the future. Like the cycle keeps changing, and this is your exact cycle. Here you go in terms of optimism and terms of pessimism. This is your chart of how I built it on in terms of greed and fear, right? You have extreme periods of greed, right? Backing nothing. It was safety. People wanted to go towards safe assets during the global financial crisis. So it was absurd. Right? The price of gold shot through the roof very, very fast. And then another crisis happened. Dollar became extremely strong. People were flocking towards dollar. And after that, you saw gold prices starting to go down, right? And as and when dollar started to weaken, you saw gold starting to do extremely well because you only need to look at gold from an alternate currency point of view. You do not need to look at it with gold versus equity. This is why I did the last webinar on the idea for gold and equity, and why gold should be viewed in a particular manner, how it should be viewed, right? Then you have extreme bouts of volatility on mids and smalls. Yeah, next best performer is extremely volatile. You can see right from this chart when I split it up and I ask you, what are you going to do? What are you going to do in this cycle? What are you going to do in this cycle? So from a long-term perspective, right, what has actually been extremely stable? Your large caps have been very, very stable. Yes, you're not making extremely high returns, but as an investor, somebody said, no, I would choose to be stable. I would choose to be consistent in performance. I would want that. I would want my savings to grow at Maruti pace, not at a Ferrari pace where there is a chance for me to crash, right? Completely respectable. And here you saw a mix of debt coming into the picture. You saw a mix of international coming into the picture. That has been volatile. Right? You are seeing volatility on all places, which means you cannot say no in terms of I do not want volatility. You are going to get that sort of volatility, but you can choose where you want to be volatile. And that's what we do in Milestones to Wealth. Right? Milestones to Wealth is a clear behavior model right? When you compare it to direct stocks, yes, you don't have that much of an expertise when you have to go towards one stock or two stocks, right? You are taking that risk of a business risk, whereas here on when we choose a behavior model, we are only choosing to take fundamental risk and long-term risk. That's it. We don't want to take any sort of risk when it comes to valuations. We are being extremely conservative because we know how behavior has played out in the past, right? And you are now seeing how behavior has played out in the past. When fundamentals reverse, things go really, really bad. When fundamentals really reverse, when sentiment really reverses, things get really bad, and you do not know for how long it's going to remain that way. You might say, no, I'm seeing yearly returns. Yes, you are seeing yearly returns. I showed you yearly data. But at the same time, if you see from a long-term perspective, which as an investor, you should think of long-term. You should not think of 3 to 5 years. You should think of 10 years plus, and this is 13 years. Right. So if I just take the data in terms of splitting for the last 5 years in terms of the gold CAGR has been somewhere around 16.5%, right? Right? Which is a very high number for a risk-free asset. Likewise, for your large caps, that number, I'll show you that entire chart for Nifty. It's somewhere around 15% or 14%, right? Which is again a really strong, really high number, right? With low volatility, right? So when you look at the market from a sense of long term, you should look at assets in the sense for a long term. You have to look at it only from a long term perspective. And even when you're doing stock investments, even when you're doing direct investments, it should be from an extremely long term perspective. And the risk that you're trying to take on that particular idea is very high rather than compared to a diversified approach. Right now, let's look at knowing that yes, optimism is there. Let's actually look at some data to see how have investors really looked at this sort of optimism. You're seeing returns, yes, but how has behavior really played out here, right? Now, so as an investor, which category would you prefer to do equity investments in? Would you do stocks or would you do mutual funds? I've kept this session a little bit more interactive than the previous ones, and I think yes, we would have some time for Q&A. So I'll slightly rush through some things. Both. Okay. There were 2, 3 people that said both. There's some that said stocks. See, my idea for both is that it should be complementary in nature. It should not, you cannot buy large cap and then buy a large cap fund or buy an ETF. That's why I had one on index funds, a webinar on index funds where we were highlighting saying we showed the data of where actually index fund money is going. It's not going into sectors. It's all crowded into Nifty 100, right? And it should all be complementary to each other. If the mutual fund is already buying, what you already bought on the stock side or what you already bought on the index side, it doesn't make sense. You don't make it's over diversification. You don't really make it doesn't work for your money. It doesn't really work for you, right? So both works only in terms of when it's complementary to the fund manager style or to that particular index. It doesn't work for the sake of it working, right? Just because you say no, that means I have a perception problem in terms of how you consider mutual funds and how you consider stocks. And they are the same thing. It's just here you're getting a basket and the other side you're just taking one. So there's no difference in terms of how they operate over an extremely long period of time. They still generate you more or less the same amount of money. Okay. Of course, there are great companies that have contributed to stellar returns, which I think I can do one webinar on who have actually contributed. If it is in line, if it does get approved, I can sort of go out and do this, but that can be a little bit into the future. Right. So I got mixed answers in terms of A and B, in terms of mutual funds, in terms of stocks. So let's look at how investors have really looked at stocks. Right. Now you're seeing here, this is all public data taken from ICICI Securities. It's all public. You're seeing a lot of people have come into the market. Like I said, when optimism comes in, you will see a lot of people coming in. Yes, a lot of people have come in. Right, you see the number of demat accounts that are there in India. A lot of people, if you see 2015, 16, 17, which was last peak, and you compare today's number, it's a lot. Right? It's a lot. It's 5 times that number, which is a lot. Right now, what are these investors really going out and doing? Right? Yes, a lot of people have come in. What are they doing? If you look at the futures and options number, uh, this is the daily traded value, right? You're seeing futures and options uh, traded values go up, which means a lot of retail investors are going out and starting to speculate, which is really bad. As from a milestones to wealth perspective, it is bad behavior because you're only trying to speculate. You're not trying to build wealth. You're not trying to save money, nor are you trying to build wealth for your future. You're just trying to speculate just to get some sort of kick when it comes to making a few bucks here and there. This is all speculative. It's not serious investors. It's not seriousness. It doesn't show seriousness. Right. It only shows that you're willing to gamble and bet the house and play a little bit here and there for some strategy and show that yes, I am able to do it. So yes, this is a viable option. Can it be a viable option for everybody that's there present? No. Right. Can it be? It's a question. Can it be a viable option for everybody? Does everybody have that skill to go out and do futures and options, to spend time to sit down in front of a screen day in and day night to see is it going to work or is it not going to work? We see a lot of madness when it comes to people working really hard to make out of their salary, trying to put out their money into futures and options, and we've seen that sort of behavior come. So it doesn't make sense for investors who are actually serious in building wealth or saving for your goals to actually go out and do futures and options because it's creating this sort of bad habit. Right? It's like smoking and drinking. It's a bad habit. Right? Ultimately, it does create a lot of issues for you for your body. So yes, it's a bad habit. Now, does everybody have time? Does everybody go out and start making money? Actually, when they go out and do this, is there data there? Yes, there is. Like, why are investors crowding into FNO? It's a direct question. So this is not a poll. So this is a direct question where you can actually type in your answers down. Okay, somebody said greed for quick money. Okay, quick money. Okay, agreed. Any other opinion? Something that we might not be aware of. Social media influence, very good answer. Yes, a lot of free time and excitement. Okay, very excited. Make daily money. High ROI on low capital using leverage. Leverage is again a problem. Leverage is really a problem. Yes, that means actually people are taking that sort of leverage. So now when you see a lot of these brokers making money, they're giving you margin money, right? So what is the quality of that particular asset? Right? Quick money, greed, impatient to wait for returns, fear of missing out, okay, misinformation, and for fun, okay, fun, okay, greed. A lot of you said greed, but I saw a lot of excitement and fun and patience. Missing out, yes, some random guy comes and tells you what to do. Okay, so who's at fault actually here? Is it the pun telling you what you should be doing, or is it the one listening to it and actually going and following through? So fear of missing out, understood. So a lot of you said greed to make quick money. You are influenced by people, whether it is on social media, whether it's in your peer circle, and you're doing this for some kick, some excitement, some thrill, right? You're going on some sort of a roller coaster to make that sort of money. So uh, are are they telling the truth? Like, do you really go out and make money? Who is it that you see some very big professional that comes in and says, yeah, I will do, this sort of an investment for you. But this is just to create awareness among people. This is an article that has come out multiple times over uh, months since October. Since actually it has come out since September, August and September. This is when we started seeing really high uh, numbers in demat accounts opened. And since then, at least every month or so, this one article comes out saying that, you know, the SEBI chief is really surprised in the interest of with the level of interest in FNO. And she says that 9 out of 10 individual traders don't make money. right? They are making a loss, right? There is a 90% chance that investors will lose money in F&O segment. But if you take a long-term view in F&O long term, you will rarely go wrong. Right. That means you have to take a long-term view, not an F&O. F&O is speculation. So she's saying that you have to go more towards, you know, uh, consistently contributing, looking for stable return, and you need to do only this, right? And there's the link of the article also. This is from LiveMint, so it is a good article. If you go through the entire thing, it really shows you as to how much of a jump has come in the interest of FNOs, right? And you're already seeing the sort of data that I showed you, right? So yes, people do get a kick out of it, but where is the kick coming out of? It's just coming out of the screen because nothing comes into your pocket. 90% of the investors that do F&O don't really go out and make money. So you cannot go play for your ego, say, no, I'm going to be the 10%. I will be that 10% that goes out and makes money. Yes, you follow me. That doesn't happen because somebody else on the other counter has bigger pockets than you do and definitely has bigger patience, bigger guts. Everything is big on the other side of the counter, right? This is not like equity stock where it's not very liquid. You cannot go out and start selling. Somebody has to be on the other side of the counter. Somebody has to be there to take up that paper. Otherwise, you will keep on incurring losses. You will continuously keep on incurring losses and you will lose your entire capital. Plus, you will have to borrow again to pay for whatever you have lost. Right. So it's a vicious cycle. So these are behaviors that we have seen, right? So I'm sure that here, if any of you are participating in FNO, definitely do rethink about this. It doesn't work in the long term for if you're very serious in building long-term wealth, then you should rethink the strategy that you want to apply. Now, how does M2W really go out and start helping investors, right? We'll get to how M2W, we have seen how cycles play out. We are seeing what is it that you as investors really think of when it comes to a particular idea. There's a lot of recency bias that comes in, right? This is what we have seen in the past. This is what we want to break, right? Where yes, performance does come in, but it doesn't come in because it has come in before. It comes in over a long period of time with as and when things start changing, right? You have to go only with that model. Now, this is the same greed and fear chart. And what is it that we tell and we try to impart in our investors who have come on board with us on Milestones2Wealth is very simple, right? Boring market, we encourage investors to continuously keep participating by making them save more. Whenever there is a good time for you to go out and start uh, you know, saving money into the market, however deep your pockets may be, if you're able to consistently contribute, please do consistently contribute. That's the sort of behavior that we only try to impart. Nothing to do with where you should invest. That definitely we are trying to give you the sort of fundamental research when it comes to conservative investments, right? We don't look at taking extremely high risk where investors go through a bad cycle, where only if it makes sense for an investor to do it, based on fundamentals, based on our experience, based on what we have seen across cycles, only then we will go and start doing it. Otherwise, the fundamental behavior that an investor should do, and what is it that we make them do, is consistently contribute in terms of SIP. Second, if you get a bonus as and when you start growing as a person, as and when you start growing in your life, definitely your contribution to what you save should go up, because that's you we treat this as financial savings. We do not treat this as speculative assets, right? And then whenever you get the time, whenever there are deep markets, deep cuts, definitely that calls for a lump sum, right? We have been giving calls for certain ideas that yes, this makes sense for you to do a lump sum. These ideas do not make sense for you to do a lump sum. What makes sense is to stick and keep on doing exciting. Right? So what does that actually lead into? It leads into us reaping that benefits when there's an exciting market. We love boring markets. Boring markets are the way to go. Exciting markets are not. Exciting markets are us for us to think of what is going to happen in the boring market, and assuming that the excitement stays, how do we get a boring idea? That's what that was the whole experiment of Shamsa's boring portfolio also. That no, we will do conservative investment. We will stick to conservative valuations. We will be aggressive in how we want to deploy it. But in terms of what is the right thing to do in that particular market, for that, definitely we have to be conservative. Right. So wherever there are, and conservative doesn't mean, doing only large caps. We are doing a mix of, it's a multi-asset approach. So we are doing a mix of equity, debt, and stocks. And M2W investors would know the calls that we have given for lump sums, the calls that we have given for SIPs. So they would know and they would vouch for it. But the entire idea is to capitalize on boring markets and then to capitalize on exciting markets, right? That's Milestones well. It's a behavior model. It's not recommendations. It has nothing to do with what we are buying. It has everything to do with your behavior. And we only and the reward that comes in is straight to the investor. There's nothing that comes to us, right? Now, how do we go out and start creating it? We only do it from a habit. We only try to inculcate these habits in our investors. We tell them that you need to set up a monthly SIP. So whatever you do, make sure how much ever you can contribute. First thing, as the best thing for you to do is this sort of a net practice. Set up a monthly SIP. Then invest whatever surplus you get in this whenever you get it in really good markets, and step up your SIP whenever possible. Right. So our only idea is to make sure that your for you to do SIP and for you to step up your SIP whenever it's possible, in the background, your habits need to change, right? Where you are sort of spending more that is not needed for you, whatever is an impulsive decision for you, you actually need to sit down with yourself to understand, make yourself aware of where you are spending a lot of money. And had this money gone into my savings, I would have done much more better than what I am doing now. Right. We do sit with investors also to guide them to say no. Maybe this is something that you can look to do, and ultimately it is the call of the investor. But the fundamental idea is to create an investing habit and to create a savings habit. Right? Think about saving every day. Review your savings every week. Strive to do more. This is what fundamentally we make investors in Milestones2Wealth do. We only want them to get fitter and fitter and fitter, so that in return, when the time is right, you can reap the benefits out of it. So actually, we've had a good 1.5 years of M2W, and we have partnered with a lot of investors who have supported. They have come forward. They have strived to do much more harder, and whatever benefits are that they are able to reap it. And what has happened is this is a culmination of all the portfolios that are there on Milestones2Wealth. It's all risk based, it's all goal based, and the average that has come in. See, we don't take risk. It takes time. The way we deploy, the way that the money gets deployed, is has nothing to do with long-term returns. It just has to do something with valuations, where we are conservative on valuations. So if you see over, as time goes by, yes, these portfolios do much better. But the idea is not to show you that it's done well in 1 year. The idea is, yes, the model works when it comes to conservatism, and this is a multi-asset approach. So there is not at all. So the percentage that is going into equity is only 80%. The rest is in debt and in precious metals, depending on your risk score, depending on your risk profile, depending on what goals to come in. Whatever it is, it's tailor-made for you, right? And whatever is tailor-made for you will work only for you, will not work for the other investor. Right? That is very simple. We only try to do this. Right? Now, when you compare it to direct stocks, the diversification that direct stocks have to offer to you are very low, because you are taking concentration risk of just doing a couple of things. Uh, a small portfolio or a long portfolio, which it doesn't really give you that sort of diversification, right? Because we are taking a multi-asset approach, diversification is very high. Returns you have already seen when you do direct stock investments, it's more volatile. But because here we are choosing a diversified approach, and not in terms of equity. No, we don't have 10 funds of that matter also. No, we don't really like doing that. But because we are taking diversified approaches. You saw from the big chart, some ideas work in one cycle, some ideas work in the other cycle. So all we try to do is to play the cycle, and that leads us to get some sort of consistency. Like operational efficiency, high in both. You are able to buy everything in a nutshell. In one go, you can buy everything when it comes to direct stocks or when it comes to our mutual funds. So the cost that you pay for direct stocks is high. We don't have any charge. We don't charge you any fees, nor do you have to pay for
account opening, nor do you have to pay for maintenance, because for brokers that are there, zero brokerage accounts, you do have to pay, at one time when you open an account. At the same time, every year you have to pay them for maintaining that particular account. We don't have any other charges. The only thing that we have is stamp duty, which I think even they have in terms of STT and other charges. So the cost is very, very low. So because we are choosing regular plans, the only thing that comes is as commission, it just comes from the AMC. But apart from that, there is no cost added that we are doing for you. And I've also done I think one webinar on how regular funds and direct funds actually play out in the future. There's no difference, right? We have actually done that sort of webinar. So if you do want to know about that webinar, do get in touch with the team. I have put the number at the end, so that you can look at it. You can make an informed decision of your own. So our goal is very simple: is to enable investors to deal with tough markets and tough market conditions. You're seeing markets are really, really tough over the long period of time, and we only want to train you for you to deal with tough markets, so that you know what you have to do in that particular market. It has nothing to do with the right thing. What you should be doing, you should know, you should be aware of, right? By doing that, we are helping you to build versatile portfolios that can weather through whatever comes in. Whatever problems do come in, you are able to weather through it, which means that your drawdowns are really low. You might fall lesser than what the entire market falls at. Yeah? Your wealth would fall much lesser, right? The entire of idea of Milestones2Wealth is to fund for future goals. That's why we have split up in terms of helping you to achieve very, very small goals, even if it is 2 lakhs, even if it is 10 lakhs, even if it's 25 lakhs. And we've set a broad target that investors who are partnering with us for Milestones2Wealth, our endeavor is that yes, over a period of time, you would be able to save a corpus of 1 crore. That's your journey. That's the target that we have set. That yes, over a very, very long period of time, you should be able to save that much, not save that much, right? And that timeline can vary for different investors, right? Only then we can be. We want to be that part of your wealth creation journey, and that's why we have set up this sort of a behavior model, right? Some people might take some longer time, some people might take lesser time, but the whole idea is that yes, we want to build portfolios that can weather through tough conditions, and that can only happen by partnering with you if you show the right behavior and be consistent and be disciplined when it comes to achieving your milestones, so that or whatever goal you have in the future, be it education, be it retirement, be it funding for a house or buying a car, everything really gets met, because everything now you're seeing so many demat accounts open. We are all included in this. There is high level of inclusivity. So you should go on the right path when it comes to saving money to building wealth. Right. What should investors expect? Like I said, 3 years, 4 years, you're seeing by very high volatility. But 13 years later, right? Let's say an investor started 2010, right? 13 years later, 13 years later, where's the number? 10% return, right? That's where investors in Nifty 50 have made if they stick in for a long period of time. This is point to point, which means 1st January 2010 up until 31st January, sorry, 31st December 2023. This has no data in terms of SIP. This has no data in terms of behavior. This is just point to point, because we always look at point to point. We don't really look at the contributions that we have made consistently over periods of time, right? So I'm going to open the floor for Q&A. We have 10-15 minutes for Q&A. So you can ask me any sort of question, but we have 10 minutes, so you can go out and start asking me. I put the number here, so do take down this number. Do send us a hi here. We'll be able to get in touch with you. And if you do want to get in touch via email, our email ID is info@milestones2wealth.com. So you can look at that also. So whatever questions you have, do put it in the chat box, and I'll be very happy to address it. Okay, the first question that has come in is there different M2W portfolio solutions? Yes, there is. See, it depends on your, again, everything is going to be based per your risk profile only. Broadly, what makes sense that everybody would have, but for you specifically, something would be there based on a risk profile, based on whatever goal that you have, right? Only based on that, definitely you will have a different portfolio. No problem in that. Right? This is not a service that we started off now. We have been in the market for 13 years or so, but right now it is the right time for investors to start thinking of uh, uh, having realistic targets, realistic milestones that you should be able to meet. Right? Can I start investing in Japan now? Curiosity kills the cat. See, Japan has been uh, for 2 years they've had good performance, but you should look at the fundamentals for that particular country. What is it that they're doing? Why is it that the performance went up? A lot of FII money has gone into Japan. A lot of FII money went out of China. A lot of FII money came into India, but then went out of India and then came into India. So you should know where is the optimism coming from. Just because it has gone up doesn't mean that you should go and indulge in it. Yes, curiosity kills the cat, but you should definitely read into why that optimism has come in. Uh, uh, can you share any workflow for investors to get an idea how their money being invested after set up SIP with M2W? I just want to know if I thought team would buy shares. No, this is pure mutual funds. This has nothing to do with shares. We don't use shares at all. It's only mutual funds. What data you saw was only mutual funds, only regular mutual fund plans. There's no shares in this. Showing you SIP, we see probably we can't do that because that is client sensitive data. But to answer to the second part, there's no shares. It's just mutual funds, regular mutual funds. And the mutual fund market is very large. They keep innovating and coming up with new products. And we have a team that works. I'm also in part of that team that works in researching on mutual funds because anyways, they are a basket of stocks. We already have an in-house team for research that works on the PMS. So there's a good exchange of data that comes in. There's a good exchange of views also that come in. So it's all regular mutual funds. How to calculate when I reach 1 crore at the current rate? Please do text us on this number. We will be able to help you as to how much you're doing and when you'll be able to reach that target. Given very low expectations of returns as well, do get in touch with us. We already have a team that can help you do that. How does the cost of investment through M2W get cheaper than direct investment? See, over a period of time, uh, let me see if I can find that presentation and present it here. But over a period of time, even what the data showed is the difference is barely 0.5 or 0.7%. Okay. And expense ratios are coming off. The only part where the expense ratio is high for a regular mutual fund is for sub 5,000 crore AUM, sub 3,000 crore AUM. Right? None of you are going to that part by taking that high risk of because they are all new funds, you don't know anything about them. Nor do we do NFOs. We only try to back fund managers that have immense experience in the market that have gone through this sorts of cycle. But the whole point is when it comes to direct mutual fund or regular mutual fund, it's just 0.5. When it comes to stocks, there are hidden charges. When you are buying a stock itself, and because majority of money goes into small caps, the whole point is that it's not liquid. So the spread is very high, right? I might want to buy it at a particular price, but on the counter you get it at a separate price. The spread between what you want to buy it at and between what the other person is, that the broker or whoever is on the other side is getting sold at on the exchange is quite high because it is not liquid. So whenever you get the time as an experiment, you can do it on your own. But the whole point is that when you go to execution only platforms, you have to pay even to get your return statement. You don't even know what XIRR is. Right. So we don't have any costs of that. No, no, it's nothing. We don't even charge you for opening an account here. We don't even charge you for maintaining an account here. The only thing that you have to pay is some stamp duty, which is government link. So you don't have to do anything. And the difference between a direct mutual fund and a regular mutual fund over a period of we've been on the direct side, we've been on the regular side. The only point is we want to make sure that no, these are savings vehicles that we want to use, whether it is direct or regular, it doesn't matter. Right? And the expense ratio is only high for that should not be a conversation because over a period of time, the difference only on a CAGR basis is just 0.5 or 0.7. That is tracking error actually. That's it. No stocks are recommended in M2W, it's only MF. Only MF, M2W caters for equity only or debt? No, it's debt also. It's multi-asset. It has nothing to do with only equity. It's multi-asset. What makes sense is what will happen. That's it. Right now, we start off doing only debt. We don't even do direct equity. That's why I said what makes sense is to go direct goes direct. What makes sense to go from a precious metals point of view, definitely goes in as precious metals point of view. And how much is okay for a particular investor also depends on that particular investor. Right? Depends on your risk profile, whether we can go overboard, whether we can't go overboard. All that also comes into play. But debt also is a part. In fact, we have started to give calls for debt as to what you can do, because valuations are quite fair. Everything is priced in. So the opportunity is only on the other side. Right? And Shamsa has done a lot of videos on the multi-asset approach. We have our in-house multi-asset PMS, which is dynamically managed also. That is Sphere, which again I'm also a part of that. So we get enough information on internally itself as to what we can do on the debt side, and there are debt ideas that we are very seriously pursuing. I have just started my SIP in M2W. How do we get notified to do lump sums while dip in the market? Do we get notified by email, SMS, or call? You will get a call straight from your point of contact. And I keep doing such webinars. I keep doing such information where I talk about ideas that we are trying to pursue and whether it makes sense for you to do or not. Only if you have the risk appetite, risk capacity, only then yes, definitely you can do. But yes, you will get notified straight away. You will get a call straight away, and we do give out uh, investor-wide messages via WhatsApp also. So if you have saved our number, definitely you will keep on getting notifications. And it's not like 2% or 3% dip. No, there's a really good opportunity for a lump sum is when you will get it. Right now, you have just started your SIP. Please do enjoy that journey of your SIP. Yes, you will get. What about bonds? Bonds we don't do, but I must say for bonds, uh, see, it's a dealer-driven market. If you buy a bond, see, I respect debt fund managers a lot, because the kind of work that goes into debt as an idea, debt as an investment is really high. It's very, very high, because you are not sticking with a 10-year horizon or a 5-year horizon. That I'm not talking about it being because we say 5-10 years, because you have the luxury of liquidity where you can come out of it. For debt, it's not very liquid, right? It's a dealer driven market. Only the papers that are very highly traded are short term, ultra short term, GSEC. Apart from that, none of the papers are traded very heavily on the exchange, right? Because it's a dealer driven market, you are stuck with the paper. You have to take that paper only if you're very serious, only if the fundamentals are very, very strong for decades altogether. Only then it makes sense. So we don't do bonds for M2W, but if you are interested in bonds, then do get in touch with us. We do also do when it comes to seeing which bond really works for an investor, we do that. So you would only see us partnering with uh, houses that have been there for a very long period of time, decades, but nothing just for the sake of buying a bond. So this option, this comparison of debt to bond has to be from a point of, okay, I'm getting interest, and this interest I want for a long period of time. I'm okay to commit this much money. This has nothing to do with the comparison. Just because you're getting 0.5% extra, you should not go to a bond just because you're getting 0.5. That's what happened with Divan housing, and that's where investors lost a lot of money because of that extra that they were trying to get. Right? Debt funds usually give you 7.5%. In this sort of a market, 7.5% is a very good number. Corporates might be somewhere around 7.7 or 8. That's a very good number for you to look at. From a debt perspective, you need to look at debt only from a debt perspective. They are supposed to meet very certain needs. It's not meant for you to grow your wealth. It's meant for specific parts. If you're extremely risk averse, then it makes sense for you to go over it. Apart from that, if there is a particular goal, short-term goal that you have to meet, where this particular goal you cannot take risk, then it makes sense for you to have debt. Right? Definitely, you should look at that option. But it has nothing to do with trading. It has nothing to do with anything. We look at it when there is no option, where we find that this place is or these vehicles, these ideas are very juicy to look at from an opportunity point of view. You might not get that chance again. So you should then look at it. Otherwise, you shouldn't. Or you shouldn't have that comparison, actually, bond versus debt. What is the minimum required? No required minimum. Nothing is a minimum. You can start with whatever you want. I'm already in M2W and doing good returns. Is it right to step up? Yes. it is the right time for you to step up. We have already given multiple calls on ideas that we are looking at from a new idea perspective. So definitely, you should step up your SIP. M2W via demat form or folio? No, M2W is not via demat form. We have to open your account with BSC, with NSC. Whatever paperwork is there, we will help you. But everything is going to be in your name. You will see it on a CAM statement. You will see it everywhere. We are not taking ownership of anything. It's going to be with you only. Right. Whatever approval has to go through also will go through you only, because we are raising transactions via BSC and NSC. You have to go out and only approve it. So it's not via demat. Regular plans is not via demat. Like your broker will take more money if you do regular plan. Yes, you will receive 100%. You will receive it. In fact, step up if you are having extra money. You can also start on your own in the same funds. I don't think there is. Broadly, I know how much allocation is going for what. So we have chosen very conservatively only. So step up you can do on your own also. Lump sum calls 100%. Yes, you would get a part of it. NRI, yes, he can start in MF. Why can't he start in MF? 100% he can start in MF. Depends on where he is. If he's a US Canada resident, then we will be okay. US, then we will be constrained to the number of houses that we have to look at. But we have a universe of what we can do for investors within that particular house also. So everybody is open to this. There's nothing that these individuals can't do, these investors can't do. Everybody can do here. We will do everything that's tailor made for you within whatever requirement India has to offer. So we had one meeting in person, which was the conclave. I don't think there's another plan. Maybe couple of years in the future, maybe 2 years later. But we had one very big event in Chennai. It was in person. It was an all-day event, and we spoke completely about. Again, that was more behavioral, but uh, uh, I can see if that the link is there, but I don't think that link is there because it was in person. So you will be notified when you have, some when we have an in-person engagement, but you have to save our number for that. Only then you will get it. We will put it online also, but it's better if you save our number. You'll keep getting direct uh, SMSs. You'll get calls also as well. Will you share your contact number? I'm on LinkedIn. Uh, I'm on Twitter. I'm on LinkedIn. I keep doing short. They make me do short reels for Milestones2Wealth and other platforms as well. So you can get in touch with me on LinkedIn, no problem. I have a MF investor with another distributor for a decade. I'm not in touch with him. Can I change the distributor? Yes, you can get in touch with our team and we can do it for you. No problem. Apart from the initial risk appetite that was assessed during the start of employment, any plan to assess, let's say, once in 2 years? That's a very good question. See, the whole idea is that as you grow as an individual, as you grow in your life, as your portfolio starts growing, your risk appetite will change. Right? Because you're maturing as an investor, you're maturing as a person, you've witnessed a lot of things, you become aware of a lot of things. That's why we will do uh, we will evaluate your risk profile in a couple of years, but it's not going to be 2 years or so. But yes, we will review your risk profile. It can be lesser also, depending on what has been happening in your life. But again, that is investor specific. But definitely, it will get assessed. I mean, you have to get assessed. Yes. How frequently does the portfolio churn? To be very honest, we don't churn much. See, even you saw from the chart, right? It takes a long time. When we choose a particular uh, idea for investors investing, which is more conservative, it takes 2 years to build the position. Like that's why you saw in the first 6 months also of when you compare it to Nifty or you compare it to whoever you want. By the way, Nifty is not the right comparison because this is multi-asset, right? The comparison is done to Nifty only because we as investors have to look at something, otherwise it's not right. Right, when you compare, even when you're personally comparing to something, compare it to what it's relevant to. This is not a relevant comparison, but this is the most uh, common comparison. It's not relevant, but it's common, hence I put it. So that's why you saw in the first couple of months you did not see something coming in, because it takes us 6-7 months to build a position. It depends on the market. If uh, valuations are extremely high, then we don't really look at doing some sort of lump sum or that sort. We try to stretch that investment out, just to take lower risk, just so that we can do it. Right. So our churn is very, very low. We build and we hold on for a long period of time. Right. Churn is very, till now we have not churned at all. When we do invest in an idea, when we do suggest, we don't really make them churn a lot. Only if the idea is played out, we will make them to churn. In our other service, that is during the advisory service, and in fact in PMS also, only when the idea plays out, is the same behavior that we are doing on the mutual fund side. Only when the idea plays out, it will go out. And other than that, it's very low. So Sphere, for example, is a multi-asset PMS. Churn ratio is only 30%. This is 2.5 years, 2 years. Sphere is 2 years old. Even Solitaire, for that matter, which is 4 years old, doesn't have much churn. It's around the same area. In the last 2 years, are there any calls to switch funds? Uh, I don't quite understand the question, but I think what you're trying to ask me is, have you switched anything in the last 2 years? No. We have switched from debt to equity, yes, but no. So churn ratios are usually very low. That's what I'm trying to tell you. Thank you. I don't think there are any further questions, and I've taken a little extra time, taken 15 minutes extra. Thank you so much for joining in. Take down this number, do text us, do get in touch with us. You can email us. We will be able to help you out in whatever requirement that you have. And our entire idea is to get you to think of a particular milestone and for you to work in that particular manner. Right. Thank you so much, everybody. You've been a great crowd. Have a great weekend ahead. I think it's a long weekend. Have a great weekend ahead. Thank you so much. Thank you.